Hey everyone, thank you for joining us today on this nice warm July day. I appreciate you guys taking the time to take part in tonight's educational webinar on San Diego real estate and an economic update. There's a lot of changes happening in the real estate market, so we'll get right into it because we have a lot to cover in the next 90 minutes. As you saw in the chat, if you have any questions during tonight's presentation, feel free to type those into the chat and we'll answer all the questions at the end. Hopefully we'll answer a lot of them too as we go through tonight's presentation. With that, let's get started with the first quick introduction. My name is Patrick Kappel. I'm the team leader for the Kappel Real Estate Group based right here in San Diego. I have a little over 15 years experience in real estate. And as you see there, I also served in the Navy for over 20 years. I still serve to this day as an officer in the Navy Reserves. The education there you see in the center, bachelor's degree at the U.S. Naval Academy, followed by an MBA with a focus in finance at UCLA. And last but not least, a master's of science degree in real estate. I always like to share that educational background with my audience to share the fact that when I discuss real estate, although I work in real estate sales, I always like to approach it not from a sales perspective, but from an educational perspective, because I believe if you fully understand real estate, it'll sell itself because it just makes sense to own real estate, as much of it as you can, rather than renting it. You can see the awards on the right. We're one of the top producing teams, not just in San Diego, but throughout the United States. Our team typically sells about $10 million in real estate per month. And with that, I always like to say who you work with matters. If you'd like to work with a good and educational real estate agent at the end of tonight's presentation, feel free to reach out to us, and we'll definitely look forward to helping you buy your next investment property or your next house. Here's my email. Best way to get a hold of me is that email address you see at the top, patrick.kappel@compass.com. If you would like a recorded copy of tonight's presentation, or if you would like to access any of our future recordings or past recordings on real estate, such as how to buy your first home, how to buy real estate, shoot me an email and I will direct you to our YouTube channel so you can watch this recording and share it with all of your friends and family. So starting out, I always love to start with this slide, and that is that San Diego today is San Francisco circa 1990. What do I mean by that? Well, there's a big technology change that came into the Bay Area in the 1990s, and it was the silicon chip. The silicon chip created a boom in the Bay Area that forever changed the real estate landscape. As we all know, you don't have to have worked in tech to have made millions in San Francisco in the 90s and early 2000s. You could have simply just owned real estate. Well, the tech boom that occurred in San Francisco in the 1990s is now happening here in San Diego. But we're at the very beginning of this tech boom, and it's a little bit different. This time it's based on biotech. So I like to also share that a lot of people will say there's no crystal ball and nobody can see the future, and there's no such thing as a real estate crystal ball. To that, I say malarkey. There's crystal balls all around us that show us the future. And the crystal ball, when it comes to real estate, is data and analytics. And if you know how to interpret data and you know how to analyze data, you can start to paint a really good picture, not only of where we're at, where we've been, but more importantly, where we are going in the real estate market. So for the next 90 minutes, you are going to see a lot of data. We're going to interpret the data to see what direction the real estate market is going and why. We always say that an opinion is worthless, but data is worth $1 million. So let's take a look at some data tonight, because that is our crystal ball. In the thesis statement that you'll see trending throughout this evening's presentation, in that San Diego today is San Francisco circa 1990s, is that San Diego home values right now are undervalued and they're about to explode in prices. And you might think to yourself, what do you mean, Patrick? Home values in San Diego are already around $1 million. Yes, and home values in San Francisco are well over $1 million. And you'll see through the data, why right now in San Diego, we're kind of where San Francisco was, where this red arrow is pointing in the early 90s. And San Diego is about to hit a big growth spurt boom that is going to increase our values here in San Diego forever. So topics. We'll look at some of the latest data. June data recently came out, so we can look back about a month and see what happened in the last 30 days. We'll take a look at what's going on in this economy. We'll drill in specifically to the San Diego economy, San Diego housing, and we'll close it out by taking a look ahead in what forecasters are predicting for 2024 into 2025. I always like to cite sources. Keeping Current Matters, UCLA Anderson, SANDAG, the San Diego Association of Realtors, and the California Association of Realtors. A lot of these are open sources. Some are sources where I get specific data just for being a real estate agent. I also like to say headlines terrify, data clarifies. So what we're going to do today is cut through the headlines and some of the misconceptions out there, because at the end of the day, a lot of times the journalists writing these headlines don't have backgrounds in economics, finance, and housing. So tonight we need to look past the opinions of headlines, past the opinions of grifters, and take a look at real data. So get ready for one of the most data-intense presentations of your life, centered around real estate and the San Diego real estate market. So big picture, we don't have an interest rate problem. Yes, interest rates are higher than we've seen in the past. They're around 7%. But at the end of the day, the real problem that we have with real estate is housing. We have a lack of housing inventory. And at the end of the day, the value of everything comes down to supply and demand. With anything, it doesn't matter if it's housing, food, or vehicles. If we don't have enough supply, you will see prices go up, period. And the lack of supply, as you're about to see in some charts, has been something that has been boiling up for over a decade. And now that rooster's coming home to nest, the fact that we don't have enough supply for some of the largest demographic generations coming in the first-time home buyer age. So let's first look at the latest monthly real estate data. This slide paints the picture of what's going on. You can see here that we have hit a new peak in San Diego real estate prices, and that peak is not slowing down. You will, mark my word, continue to see San Diego real estate values go up as the year goes on. We hit the dip, guys, in December and January. You might remember that real estate interest rates were really low in the 2s and in the 3s. And then around April of 2022, going into May, interest rates started going up. We hit a peak in San Diego on real estate prices in April of 2022. And you see it right here where I'm circling the cursor in 2022. Interest rates started going up. And as interest rates started going up, buyers got scared, some buyers moved to the sideline, and real estate values started going down. They bottomed out in December, January, and then buyers got used to the new rates. And as I said, even a year ago, interest rates are not what is pushing down home prices. It's lack of inventory. The lack of inventory, there's still buyers in the game. We have seen prices go up over the last 5 to 6 months, and we're now back at $1 million. Believe me when I say within the next 10 years, maybe even as early as 5, you will see home values in San Diego go to $1.5 million. Within 10 years, probably $2 million, based on the average rate of appreciation we've seen in the last 30 years. Imagine this, if you bought real estate in January, when we hit that low, if you did a 3.5% down payment, which you can do, 3.5% is usually the minimum down, you would have put down $29,715. And if you bought the median home for $849,000, in just 5 to 6 months, the value of that home went up $151,000. That's a 508% return on your money by putting down just $29,000. Now, we can't go back to January, but when we look at the data that I'm about to show you, I think you'll agree that home values will keep going up throughout San Diego County because of the economics and job growth that's happening here. The chart you're looking at in front of you simply shows the last 12 months of median sales prices in San Diego in the upper right. Now, the column on the left is single family detached homes. The column on the right is attached. So that would be things like condos. And you can see that real estate values, as I mentioned, went down going into December, January. We've been on a hot streak going up ever since. The graph on the bottom shows you simply the median sales price going back 10 years. And we've been at a pretty healthy clip of appreciation of around 5 or 6%. But now that we are hitting that lack of building that we have not done over the last 10 years, intersecting with millennials and Gen Zs, some of our biggest generations getting into the home buying market, we're starting to see rapid appreciation. And that is coming in at the same time that we just don't have inventory. You can see in the graph in front of you the number of new listings coming to market. Now, in San Diego, any given day, we typically have around 8,000 plus or minus homes for sale, and that was pre-pandemic. In this day and age, we typically have less than 2,000 for sale. Why is that? Because we have about 1,000 to 1,600 homes coming to market every month, but we have that much, if not more, being sold off every single month. As you can see in the chart above you, during the summer seasons, we used to have 3,000 to 4,000 homes coming to market. And now it's a fraction of that, sitting around 1,600 new homes every month coming to market. Because of that lack of inventory, and because there's still a lot of demand out there, we're seeing most homes sell slightly above list price. You can see right now homes are selling about 101 to 102% of list price, and that's been edging up over the last 12 months. You can see for the majority of this year and most of the end of last year, homes were selling below list price. But we're back at that situation where there's more demand than there is supply, homes selling above list price, and that trend will continue on. In fact, you can see that trend has been growing since December. The percent of list price to sale has been going up ever since over the last 7 months. Another data line to look at to know what direction our home price is going to go is following the trend of days on market until a sale. This is simply how many days does it take for a seller to put a for sale home sign in their yard, property goes online for sale, to an accepted offer going into contract. And you can see we started out the year, January, with it taking about 43 days to sell a home. Ever since January, days on market to sell a home has continuously trended down. In April and May, it was 29 days. Last month in June, it went down to 24 days. Same thing happened with attached homes, condos. You can see on the right, ever since December, January, we've trended down, and now it only takes about 20 days. So what direction are home prices going to go? You might be asking yourself. Well, if you look at this trend line, as days on market goes down, we see home prices continue to go up. The fact this trend has been continuing, one can only anticipate that home values will continue to go up through the month of July, August, September, and throughout the year. Inventory of homes for sale, as I mentioned, we're sitting around 2,000. In fact, throughout this entire year, if you look all the way back to January, here in the top right, we started out with 1,930 homes for sale, single family. That trended down. It's gone up a little bit only because we got in the summer buying season, more sellers came to market. But I really want to draw your attention to the bottom graph that shows pre-pandemic years. And you can see in pre-pandemic years, we typically had 10,000 plus or minus 2,000 homes for sale at any given day. And that's single family homes. Today, we have just over 2,000. So in normal real estate markets, guys, we have 5 times more homes for sale than what we have for sale now. And it's that lack of inventory that's causing values to go up. The median sales price now, as you saw, is $1 million. And at the end of the day, it doesn't matter if we think $1 million is a lot of money. It doesn't matter if I think $1 million's a lot of money. It doesn't matter if you think $1 million's a lot of money. It doesn't matter if your friends and family think $1 million is a lot of money. It matters how many homes are available to sale. And I once had a mentor tell me, if you want to see something clearly, reduce it to the ridiculous. And let's say there was only one home for sale in San Diego County, and we know that's ridiculous. But just imagine that for a second. If there's only one home for sale, how much would that home sell for? Millions and millions and millions of dollars. Now, take it to the other extreme. Let's say there were a trillion homes for sale in San Diego. There's not even a trillion homes in San Diego, but let's say there were, and they were all for sale. How much would they sell for? Almost nothing, dirt, because there'd be so many of them. So really puts in perspective, at the end of the day, more powerful than interest rates is the supply that you have relative to your demand. And we simply don't have supply. That is what's going to ensure values keep going up in San Diego. So let's get into some of the economics and data that's affecting the supply, affecting the demand, and affecting prices. And let's take a look at the trends, how they've been going the last couple of years, and how they're likely to go the next few years, so you can walk away with an idea of what direction home prices will keep going. So this is the demand side of the equation when it comes to supply and demand. And the demand is people, specifically people that buy homes. Now we know that typically your first time home buyer is about 33 years old, plus or minus. We also know that millennials are one of the biggest generations ever, followed by an even bigger generation, post-millennials, also known as Gen Z. Now, during Gen X, which I was kind of at the tail end of that generation. I'm 42 years old, but during Gen X's generation, we didn't have that many home buyers, and we didn't build that many homes because Gen X was a smaller generation, and we were coming out of the Great Recession that we experienced in 07 and 08. Because we didn't build enough, we're just not properly ready and built up enough for millennials and Gen Z. And oh, by the way, millennials are now in their early 30s. Some of them are even up around 40 years old. But the biggest cohort of millennials, as you can see the red line pointing to, is now hitting their early 30s, first-time home buying age. And they're followed by that other big generation, Gen Z, right behind them. Well, unfortunately, for these huge generations coming into their 20s and 30s to buy homes, we just haven't built enough housing stock for them. This is why I say interest rates aren't the problem today. They'll change, they'll go back down. But what you can't change with a snap of the fingers is housing inventory. And when you look at the graph in front of you and you see the existing home inventory of for sale homes going back the last 20 some years, you can see quite clearly that we are sitting at an all-time low of homes for sale. And oh, by the way, that all-time low is now intersecting with the all-time high generation of first-time home buyers, unlike anything we've seen since the baby boomers. So you tell me, it doesn't matter if it's cars, food, bottles of beer, or homes. When you look at these two graphs, guys, and you see that we have an all-time low of housing inventory available at the exact same time that we have an all-time high of demand of a generation of first-time home buyers needing to buy homes, what do you think is going to happen to home values when you intersect all-time low in supply with all-time high in demand? Well, if you've taken an economics class, you know what that means. That means home values will go up. That means they will continue to go up because these two big generations, guys, they are not going anywhere. And if they have it their way, they're going to find a house to go buy. And the fact we haven't built enough homes in 10 years, it takes more than a year, 2 or 3 years of record building to make up 10 years of a deficit. And that deficit in San Diego is just as real as anywhere else in the country. You can see here in the dark blue line how many housing units we needed to add in the last 10 years just to sustain our population's growth. Specifically, we need to add about 15,000 housing units per year. And over the last 10 years in San Diego, we have built so little housing that we're now short by almost 80,000 housing units in San Diego. And by the way, if you think we can build 80,000 units quickly, you're wrong. We build less than 10,000 per year. We're building around 10,000 units per year, and there's just no way we're going to close the gap on that 80,000. So looking at this quick amount of data that we've already looked at, we're going to dive into a lot more. What is the bottom line? If you logged off in 5 minutes and you needed a takeaway, what is the bottom line? Number one, there is not a real estate crash on the horizon. The only way to have a crash of anything, guys, is to have too much supply relative to demand. If you have too much supply of anything relative to demand, you'll have a crash. But as you just saw, we have too little supply relative to demand. Thus, there is not a real estate crash on the horizon because of that lack of supply. And over the long term, folks, you will see real estate prices keep going up. Certainly over the next 10 or 20 years, because of these huge generations of first-time home buyers coming to the market. Because of these large generations coming to the market, though, moving out of mom and dad's house, graduating college, you will also see rents continue to go up. I am seeing rents in San Diego just simply skyrocket. So the bottom line is this: now is a good time to buy real estate. We know that based on the lack of supply and the high amount of demand, real estate values will keep going up. We also know, because of lack of supply and the demand of kids graduating college, people moving out of mom and dad's homes, rent is also going to keep going up. So unless you want to keep paying more in rent, now is a time to buy. So what's going to happen in the future? As I mentioned, rates are around 7% right now. They will eventually go down. Probably in the next 6 to 12 months, we'll start seeing rates go down. We'll show you why in a minute. But what we know within the real estate industry, based on historical data, is as interest rates go down, buyer demand increases. And typically when we see rates go below 6.5, buyer demand starts to pick up. When we see rates go below 6, buyer demand just explodes once we're in the 5s. So when do you want to buy real estate? Do you want to buy real estate now when rates are around 7% and there's some buyer demand, but not a ton? Or do you want to wait for rates to go down in the 6s or go down in the 5s when buyer demand and competition is completely high and insane? The answer is you don't want a lot of competition, because as soon as we see these interest rates go back down, mark my word, you will see prices start to skyrocket back up even faster than they have been going. So unless you want to pay more money for your house, I recommend you buy sooner rather than later, because as rates go down, demand will pick up. We still don't have that inventory, so you will see prices go up even faster. So which way are interest rates going, and when are interest rates going? Well, you probably all saw in the news today that the Fed raised interest rates again to a 22-year high. But one thing to clarify is when the Federal Reserve raises their interest rates, that doesn't mean they're raising interest rates on 30-year mortgages. What it means is they're raising interest rates on what they charge banks to borrow money overnight from the Federal Reserve. Does it directly affect mortgage rates? No. Does it indirectly affect mortgage rates? Yes. And we'll show you how that works. Are we going to see rates go up a little bit? Maybe a smidgen, but we're going to see them go down even more over the next 12 months than what we see them go up in the next week or two, if at all. In fact, when you look at the mortgage rate projections of some of the biggest organizations in the United States that oversee mortgage rates, you see that based on a consensus, by the end of this year, most projections are rates will be in the 6s or the 5s. And the consensus is going into 2024, we'll still be in the low sixes, if not the fives. So how are all of these organizations assuming rates are going to be in the fives or the sixes, especially considering the Fed just raised rates again, and right now we're at 7%? Well, to get into that, we need to explain mortgage rates and why mortgage rates are the way they are, and why most experts are expecting mortgage rates to go down in the next 6 months, even though the Federal Reserve just raised rates today. And as we go into the discussion of mortgage rates, take into account the fact before your eyes that right now we're sitting at 7% mortgage rates. A person with a 7% mortgage rate, if they want their monthly payment to be about $4,000 a month, all they can afford is a $750,000 house. Now, if that same person that wants to spend $4,000 a month can get an interest rate around 5%, now you can see they can qualify for $1 million price point. This is why when interest rates go down, you will see home values go up, especially as more buyers start to come into the fray and come into the market to increase that buyer competition. So as I promised, let's take a look at why interest rates are what they are, and you can go to work tomorrow and brag to your friends about how they're tied to the 10-year treasury and why they're actually going to go down. So 30-year mortgage interest rates typically have about a 1% to 1.5% spread above the 10-year treasury. Well, what does that mean? The 10-year treasury note, also referred to sometimes as a government bond, is known to be one of the safest investments in the world. And every investment in the world is based off of the 10-year treasury. And most investments have what we call a spread, a rate above the 10-year treasury that they sell at. Now, when you buy a house and you get a 30-year mortgage, your mortgage is bundled with thousands of other mortgages, and that bundle of mortgages is sold to investors on Wall Street. Wall Street investors typically want a mortgage to give them about 1.5% higher return than what that same Wall Street investor could get if they bought a 10-year treasury. So for example, if 10-year treasuries today were at around 4%, which they're pretty close to, then we would expect 30-year mortgages to be 1 to 1.5% higher than that, around 5 to 5.5%. How do we know that with such certainty? Well, look back at the graph in front of you. That goes back over 2 decades, and you can see the relationship between the 10-year treasury and the 30-year mortgage. The 30-year mortgage is the red line. The 10-year treasury is the blue line. And as you can see through over 2 decades of data, we typically have about a 1 to 1.5% spread between that 10-year treasury in blue and the 30-year mortgage in red. Well, that spread has grown. In fact, that spread has almost doubled in recent months and in the last year. The reason is because lenders know interest rates are going to go down soon. And they know that the mortgage they give you today is not going to last 30 years. It's probably going to last like 6 to 12 months, and then you're going to refinance. Because if you buy a house today and you get a 7% interest rate, you can refinance that interest rate when rates go down. So lenders are charging a little bit higher premium above the 10-year treasury on interest rates. Just how much higher? Well, you can see the gap has gone from 1.5% to about 3% on that spread. So what does that mean for you? Well, when we look at the 10-year treasury today, the interest rate's around 3.8 to 4%. So let's call it 4%. That means a 30-year mortgage interest rate really should be about 5.5% right now, but it's at 7. And I mentioned it's at 7 because mortgage lenders know rates will go down. They're afraid you're going to refinance within 6 to 12 months of buying. When will we start to see these interest rates really go down and close the gap between the 30-year mortgage and the 10-year treasury? The answer is this: as soon as the Federal Reserves tells society that they're done raising interest rates, and we're pretty darn close to that, guys. This might be the last one or maybe one more. As soon as that happens, you'll start to see the 30-year mortgage slowly come down within that 1.5% gap of the 10-year treasury. So what am I saying? What I'm saying is over the next 12 months, you will see 30-year mortgages slide down from 7% to 6.5% to 6%, and eventually 5.5%. Could they go up a little bit between now and then? You can never predict what's going to happen day to day, but you can always predict what's going to happen in 6, 12, 18 months with pretty high certainty. And we will likely over the 12 months see rates go down, which is why we're telling our clients, buy now before competition gets even hotter. Because as soon as we see those rates go down, you will see competition pick up, ensuring that you'll pay more in the future. So how do you still get kind of a low interest rate, even in the 7% environment? There's ways you can buy down your interest rates with things like a 2-1 buy down program, which allows you to have that lower interest rate for 2 years, knowing that you're probably going to refinance in that 2-year period. You can also right now get a lot of down payment and grant program money for free to cover your down payment, to go towards closing costs, or to help buy down that interest rate that you got. So with that, let's talk about the differences between owning versus renting and look at the real math. Because sometimes I'll hear people say that it's cheaper to rent than it is to own. Because let's take this for an example. What if I told you you could own a property or you could rent the exact same property? And that if you own the property, you're going to pay around $4,000 a month. But if you rent the exact same property, you would pay $3,000 a month. Now, most people would say, well, $3,000 is cheaper than $4,000, so I'm going to rent it instead of owning because it's cheaper to own it or cheaper to rent it, $1,000 cheaper. Well, the truth is, if you look past just your monthly payment and you peel back the layers of what I call the financial math and look at 10, 20, 30 years of living, you'll see that owning is exceptionally cheaper than it is to rent. So I built this model that shows the difference between a renter and an owner. And what I want to do is really zoom you in on the blue highlighted areas right now. The blue areas show a 1-bed, 1-bath condo in downtown Little Italy. Right now it would sell for about $500,000. If you bought that and you put down 5%, $25,000, and you got a mortgage at 6.5%, as we see right here, your mortgage is going to end up being around $4,000, especially when you include the taxes, insurance, and HOA that we have here on the right. However, some other assumptions you must make is if you own it, you, not the landlord, gets to enjoy the appreciation. And in San Diego, over the last 35 years, the average rate of appreciation has been about 6% year over year. Now, if you rented it, you don't enjoy the appreciation, but you probably are going to get rent increases at now and then. You could rent it today, like I said, you see in the bottom left, for $3,000 a month, but your rent would usually go up 5 to 10% per year. Even if your landlord is nice and they charge you the smallest rent bumps each year, 5%, that's what we'll use in this model. And once we put all these inputs in blue, we start to get the outputs that you see here in green and red. And if you draw your eyes all the way to the right, you'll see the person who owns this is paying $3,990 a month. That's a mortgage plus taxes plus HOA plus insurance. The person who rents it is only paying $3,000. So again, this is where most people say $3,000 is cheaper. Why don't I just rent it instead of owning it? But if you start to look deeper into the real value of owning and the real cost of renting, you see that over a person's lifetime, over 30 years, the owner pays $1.597 million, but the renter pays $2.39, almost $2.4 million. The renter pays almost $800,000 more over the lifetime of living in that property. And why is that? It's because the renter's cost of living goes up every single year with increases in rent. Whereas the owner, your mortgage stays the same for 30 years. And guess what? After 30 years, you pay off your mortgage. and you get to year 31, now you're living for $2,000 a month because your mortgage is paid off. All you're paying now is your insurance, your taxes, and your HOA. And this is even assuming that they went up over time. Whereas the renter is now paying $12,348 a month for the same property they were renting 30 years ago at $3,000 a month. And that shows just how much of a difference it can be over the term of 30 years. But the big sticker shock is this one: net worth increase. If you buy a $500,000 condo today, which is like a starter condo in San Diego, that condo appreciating at 6% per year is going to be worth $3 million by year 31. This is how you and anyone out there can become a multimillionaire. And it's crazy to think, but I'm here to tell you, anyone in America can become a multimillionaire. All you need to do is have a sufficient enough job to provide sufficient enough income to buy a $500,000 condo. And you might think, well, what kind of job can do that? There's people that make 80, 90,000 that are able to buy $500,000 condos, knowing they'll be multimillionaires within 20, 30 years. Whereas that renter, they still own nothing. $0 is their net worth because they gave all their money to the landlord that they're now paying $12,000 to. So you can see over the long term, owning always makes sense over renting. And you might think, well, owning versus other investments. What if I could put my money, that down payment, in other investments? So we built this other Excel model. Now, this Excel model shows, again, let's say you have $50,000. You've got a good job, you saved your money, you got $50,000. Well, you could put it in the stock market. You could put it in a retirement account. The stock market returns over the long term about 9% return. But let's say you put it in a really good stock market investment and you get a 12% return on that 50,000. Well, that's your blue chart over here that I'm circling with my cursor. $50,000 invested and earning a 12% return over 30 years will become worth 1.497, almost 1.5 million. That's pretty good money. And that's putting no more money into it. Again, the power of compound interest. How do you turn 50,000 into 1.5 million? But what if instead you thought real estate would be a better investment? And trust me, as a real estate guy, I was investing in real estate long before I was a real estate agent and working in brokerage. And I learned there's no better investment. You see that on the left. If you take that same 50,000 and you buy $1 million property for it, that's a median price of a single family home in San Diego, and you only need to put down 5%, 50,000. And if that property appreciates at the average rate of appreciation in San Diego, 6%, that $1 million property appreciating at 6% over 30 years is going to be worth $5.7 million. Insane. And a lot more money than 1.5 over 30 years. You can see it graphically in the graph on the right. The red graph, the red line is $50,000 invested in the stock market earning 12%. The green line is $50,000 invested in a $1 million property that doesn't appreciate at 12%, half of 12% at 6%. And you see your net worth difference. There's a $4 million difference between 1.5 and 5.7 million, guys. This is how anyone can build wealth through real estate. This also goes to show if San Diego's median home price right now is $1 million, and if San Diego appreciates at 6% a year, which we've seen for the last 35 years, what's going to be the median price of a San Diego property in just 30 years? 5.7 million. And I know that sounds crazy, but that's what happens with compound interest and inflation over decades. So macroeconomic update. Let's dive a little bit into really what's going on with this economy. And the big word of the day, of the year, the last year certainly, has been inflation. But as we all know, we're hearing in the headlines and hearing on the radio, inflation is going down and going down quite rapidly. We're at about 3% year over year now. That's kind of where the government wants to be. That's where the Federal Reserve wants to be, around 2% plus or minus, and we're there. This is why the Fed is likely to stop raising interest rates, and thus this is why soon we will start seeing that 30-year mortgage start to come down. But while we're on the topic of inflation and real estate, let's talk about how they relate to each other. As you can see on the graph in front of you, which goes back over half a century, home price appreciation every decade, the green bar, compared to inflation every decade, the blue bar, you quickly see that real estate often outpaces inflation. So if you want to put your money in a good hedge that's safe and going to hedge against inflation for you, there are a few areas better, as we see in the graph in front of you, than putting it into real estate, because real estate typically outpaces inflation. Likewise, if you're on the other end of the spectrum and you're a renter, if you're a renter, you're really getting a double whammy, a double punch to the face, if you will, because not only are you not enjoying the appreciation of a home outpacing inflation, but you're also getting hit with rental rates outpacing inflation. You can see here again, going back 50 years, that more often than not, rental price appreciation, the green line, outpaces inflation, meaning rents are often going up faster than inflation. Now, because of all the inflation that we've had the last 12 months, about 9 to 10 months ago, October 2022, as you see in the article in front of you, most economists were predicting a recession within the next 12 months. Well, the tide is starting to turn, and most economists now are predicting that we might have the soft landing that the Federal Reserve was shooting for. In fact, this article that just came out the other day says that US economists are seeing recession odds at 50-50. A big change compared to a year ago when they were saying it's 100% odd we're going to have a recession. Well, with them now saying it's a 50-50, we might have a recession, we might not. How is that going to affect home values? Well, I'm here to tell you that if we don't have a recession, people keep their jobs, home values will likely keep going up. Likewise, if we do have a recession, I'll say the same thing. Home values will likely keep going up. And you might be thinking, well, that's crazy. Why would home values go up with a recession and home values go up without a recession? Because if we don't have a recession, guys, we'll still see 30-year mortgage rates start to come down for reasons we showed you earlier. People still keep their jobs, they can buy houses, and we see home values continue to go up. If we do have a recession, though, there's certain things that happen during recessions that cause home values to go up. Let's take a look at those things. If we do have a recession, the Federal Reserve usually lowers interest rates even faster to help get us out of that recession. For that reason, more often than not, home values go up, and we saw 4 of the last 6 recessions, home prices actually went up. In fact, as I mentioned earlier, it's because of this. A recession means falling mortgage rates, and usually the bigger the recession, the more we see those mortgage rates come down. But again, this is one of the reasons why mortgage rates have been higher than the 10-year treasury, because lenders have been afraid of that recession that we might have, afraid rates would go down and that you would refi. Tying all of the, I really want to get into kind of like the sky is falling type of talk, because in my world, the sky is not falling. The future looks very bright if you look at economics. Home values look very solid and strong and will keep going up. And here's an article in front of you that shows why you can't believe the hype. One day I opened up the newspaper and I read an article that said foreclosure activity doubles year over year. And that was kind of it. It talked about how year over year there's more for foreclosures, et cetera. What that article didn't include, though, was the chart you see in front of you. That article came out in 2022 at the end of the year, and they failed to share that while 2022 foreclosures, yes, were double 2021, they were still a fraction of the level that we typically see in a normal year with foreclosures. Pre-pandemic normal years, guys, United States usually sees about 1 million homes foreclosed. Last year, we saw a third of that. There's just not a lot of foreclosures out there. There's no crash that's been happening. There's no crash that's going to happen. In fact, when you look at foreclosure activity just in San Diego, last year, San Diego ended 2022 with an all-time low of foreclosures because we just don't really have a distressed environment. Anyone out there that you might be listening to that is saying housing's distressed, housing crash is on the horizon, look at their credentials, and I guarantee you they probably don't have a master's degree in real estate and they just don't understand economics. They're just grifters trying to get clicks. And what gets clicks? Bad news. Unfortunately, all I got is good news. I guess maybe that's a good thing. So when we look into the future of 2023, all the way to the next couple of years, what are most economists predicting? Well, we can see here among some of the 6 largest companies that oversee the housing industry, most of them are averaging that we would have year over year appreciation in 2023. Now, this forecast was done at the end of 2022. And you can see everyone here in blue was right and Zellman in red, they were wrong. Because not only have we seen appreciation in 2023 nationally, but here in San Diego, prices are up 18% just this year. If you're betting against the housing market in America, you're on the losing side because the housing market is strong and it will keep going up. Now, as we look into 2023 and we drill down by these economists, about 100 of them were forecasted. How much did each one think we would appreciate? You can see the overwhelming majority thought we'd appreciate between 1% to 10%, with a few thinking even more than 10%. Those, again, who were expecting appreciation ended up being in the right because that's exactly what happened this year. But as we look forward into the next 3 years, what are these same economists predicting? And you can see each year from 2024 to 25 to 26, more and more economists are getting on the bandwagon vote of yes, real estate prices will keep going up and up and up. All the way to 2026, where almost 100% of economists are predicting we'll see price appreciation. And it has to do with the macroeconomic information I shared with you, including the fact that the largest generation is hitting their early 30s, and we just don't have the housing for them. So when we drill into California and San Diego's economy specifically, what do we see? We see the same story, guys. It all comes down to supply and demand, the most powerful economic force on earth. And as I showed you earlier, we just haven't built enough supply. You see this chart in front of you that we've already seen, that as of the end of 2021, we had an 80,000 unit shortage, and that number has grown by about another 10, 20,000, pushing us close to nearly 100,000 units that we're short now in 2023. The other thing to keep in mind about real estate is the value of real estate is heavily based on the value of the economy around that real estate. That's why we say with real estate, only 3 things matter when it comes to the value: location, location, location. And when you're buying real estate, you really need to look at the local economy. Don't look at national headlines when it comes to real estate. Look at local data, because you could have one marketplace where real estate values are going down and another marketplace where they're skyrocketing up. It has to do with the local economy around that real estate. So when you look at the economy of California and San Diego, you see that California has not just one of the biggest economies. In fact, we are the biggest economy in the nation, but we are one of the biggest economies in the world compared to other countries. We just recently came up there with Germany as the 4th largest economy. You can see on the chart in front of you, however, the last 20 years, the California economy in blue continued growing while Germany started stagnating a little bit. And when you drill in and you look at just the size of California's economy compared to the rest of the nation, you see by far we are the largest at $3.36 trillion in annual gross domestic product, GDP. And GDP is really just a measurement of the size of a state's economy. Second place, over $1 trillion behind us, is Texas, followed by New York. And why do I share this with you during a real estate presentation? Because of the previous slide that said the value of real estate has almost everything to do with the economy around that piece of property. That's why a home in San Diego is $1 million, and a home in the middle of nowhere Midwest might sell for 200,000 because there's not much money or economy around that home. That's why a home in a third world country sells for $10,000 because it just doesn't have that economy as robust. Now, what I really like to look at is what is the size of the economy per person. This simply takes the total size of the economy divided by the number of people in that economy. Now, on this map, the darker red, the bigger the economy per person, more money in that state per person. An interesting one is North Dakota, my home state, and that has to do with oil. It's not because a lot of people out there have a lot of money. It's because a few people have a lot of money, the ones that own the land that have the oil. But when I look at this, I think, where would I want to buy real estate? I would buy real estate in any of the darker colored states because those are the states that have the most amount of money per person. I would be very hesitant to buy real estate in states that have the light colored pink here, because those are the states where if there's any slunch in the market, you're going to see real estate values go down there first before anywhere else because they just have small economies per person. The other thing I like to look at is which economies are growing the fastest. And when we look at the chart in front of you, you see that it doesn't get any darker green than California. In fact, California is the third fastest growing economy. All these charts in the United States that you're looking at right now, in fact, you're going to see California consistently being shaded in the darker color because California is at the top on the size of GDP, GDP per person, and GDP growth. Anyone who knocks California and says California isn't good for business, they're reading headlines. They're not looking at real data, because when you look at real data, there's few states that have as much GDP growth as California. And when I talk about the size of it, you can see the makeup here in front of you. California, again, almost 2 times the size of most other large states, including Texas. California takes the cake with 14.8% of all of America's GDP coming from the Golden State right here. And San Diego is the golden child in California. So when you take the state with the fastest economic growth, and then you ask, well, what city in that state has the fastest economic growth? And that answer is San Diego. And San Diego is growing economically faster than almost any other city in the United States because of what you see in front of you. Demographically, we have a younger, richer, and better educated population, and we are becoming more and more educated, younger, and wealthier as people move into San Diego from institutes of learning from across the country because of our biotech growth. And you see that in the center, we are a forward-looking economy. San Diego is set up to be a city of tomorrow, a city based on tech, a city based on biotech. And you can see here, just broken down segment by segment, every section of San Diego's economy. Key thing to hit on is our driving sectors: tourism, innovation, and military. You can't take away the California weather and sunshine. We'll always have the tourism. The military is here to stay, but the biggest, fastest growing one is innovation. And that's what you see in the biotech growth happening right now. It's also important to note that no section of the entire economy in San Diego makes up more than 16% of our total economy, showing that we're recession resilient. If one section of the economy goes down, it's not going to crash San Diego because we have such a diverse economy. What you see in front of you now is the cycles of innovation throughout human history. And each cycle changed humans forever. The last big cycle we went through was computers, the silicon chip, microchips, and what we saw happen in Silicon Valley in the late 90s and early 2000s. And the microchip, the fifth wave of technology revolution, changed San Francisco and the Bay Area forever and increased home prices there forever. We're in the sixth wave today, and that is life sciences. And we're just at the very beginning of that sixth wave. There's decades ahead of us to come. And that sixth wave has decided to set up shop right here in San Diego. San Diego has become one of the central hubs in the United States, in the world, for biotech growth. And it's all these tech and biotech people that are moving into San Diego that are buying homes for $1 million, that are coming in with education, that are coming in with high paying jobs to be able to afford. Whenever clients ask me, how does anyone afford $1 million home, a $2 million home? I say, look at who's moving here. More and more, I'm seeing new buyers come to San Diego from areas like LA, San Francisco, New York, these other markets where they had good paying jobs, and they're now moving into San Diego. Along with that, we're seeing venture capital money pour into San Diego with growth unlike any other city in the United States. You might be thinking, we're here to talk about real estate. Why are we talking about venture capital investment? Because, guys, as I mentioned earlier, the value of real estate has almost everything to do with the value of the economy around it. And when you look at San Diego, which historically for the last 20 years has received about 1 to 1.5 billion per year in outside venture capital investment, look at what happened in just the last few years. From 2017 to 2021, venture capital investment grew almost 8.6x. You can't pour that much new money into a region like San Diego that's starting new jobs, that's growing in biotech, and not have it affect home prices and home values. This is why you're seeing home values go up so much in San Diego. More importantly, this is why you will continue to see home prices move in an upward trend. There is no crash because there's just too much money coming into San Diego, and it's here to stay. What you see in front of you now is the venture capital broken down by industry. And of that 9 billion, over half of it, 5 billion plus, going to life sciences. Again, as much as San Diego is a huge tech city now, it's really shifting towards the biotech and the life science arenas. So many charts that we have to share with you to really solidify this fact. And I really love this one. What you're looking at now are the top major United States cities that are experiencing tech growth. Now, it doesn't include San Francisco because that was already a tech whale. What we're looking at now is which cities in the United States have had the most amount of tech growth. And as you see amongst these 8 large cities, none of them come even close to the amount of tech venture capital money being poured into San Diego. We beat even Seattle, certainly Denver. In fact, when you look at the fastest growing tech cities, San Diego is receiving almost 2 times more than your typical tech growth city like Atlanta, Miami, and Chicago. Again, painting the picture to what city in America, if you looked at these 8 cities, which one do you think is going to have the most appreciation in real estate now and in the coming years? If you knew that you could buy a property in San Francisco in the 90s and become a multimillionaire just for owning it for 10 or 20 years because of the tech growth that happened there, and you saw the chart in front of you now, where would you put your money? Where would you buy real estate? I know if it was me, it's San Diego all day long because of the growth we have here. And you see it in the headlines. Is this article that came out not too long ago? Interest in San Diego biotech real estate is soaring. And in just the last 12 months, sales had gone over 3.4 billion, with new biotech companies now coming here to lease space, but actually own and buy space. There's so many things pointing to San Diego today being San Francisco circa 1990. The analogy is so easy to draw, and we see it through buildings and developments happening right now in front of us, like the IQHQ San Diego Research and Development District. This is the largest biotech real estate development happening on any oceanfront in the United States of America. And it's happening right now in downtown San Diego at a price tag of over $1.6 billion. Right across the street, we have the Seaport redevelopment, which is going to be over 2 times more at 3.5 billion. And you're going to see the Seaport redevelopment go up in phases over the next 10 to 15 years. And as we move further inland to Mission Valley, we see the $1 billion Mission Valley Innovation District that's going to have not only classrooms and incubators and labs for startups, but also more housing, office, and retail space. And in Mission Valley, there's an even bigger project with a price tag of over $4 billion. They've already started on phase 1 to bring in 930 apartment buildings, 75,000 square feet of retail shops. But at the end of the day, over the next 15 years, this $4 billion project is going to produce over 4,000 apartments and over 150,000 square feet of retail and 1 million square feet of office space. A lot of times when people ask me, where should you buy in San Diego, I often point to where these major developments are happening. And the big news that we had last year was Apple moving into San Diego. Apple has announced that San Diego is going to be a principal engineering hub for the corporation, and they really put their foot in the sand by buying a nearly $500 million campus. Apple isn't coming here just for a moment. They're not leasing space. They spent nearly $500 million to buy a 67-acre brand new Apple campus right here in San Diego County. We also have a lot of new medical facilities coming in, including the new $2.5 billion UCSD hospital in Hillcrest. And just a few blocks away, Scripps Mercy is also building a brand new hospital in the Hillcrest area. As we move down further south on the Bayfront again, you see the huge Chula Vista Bayfront development that's bringing over $2.8 billion in economic activity, thousands of jobs, both construction and permanent jobs. And it's going to have the second largest convention center in all of San Diego. Again, the west side of Chula Vista is a great area to buy in if you want to see growth and appreciation. And as you move east out to East Lake in the Otay Mesa area, there's a lot of industrial growth going on out there, a lot of warehouses being built, including the largest Amazon warehouse in the entire state of California that was recently completed down here in our South Bay area. And the biggest project right now undergoing is a $2.7 billion new terminal project at downtown San Diego's airport. With San Diego becoming such a big national and international hub, becoming a big tech hub, our air travel is picking up tremendously. And with that, they had to build a new terminal with new sky bridges. And we're going to have a lot more air traffic coming in and out of San Diego. Last but not least, you can't talk about San Diego without talking about the military. We have this huge thing called the Pacific Pivot happening, where 60% of the U.S. fleet is shifted out here to the west to really protect our Pacific front. What a lot of people don't think about, though, is every single year, over 15,000 military veterans come off active duty in San Diego, and half of them, if not more, remain in our region, adding to our ever-growing and educated workforce. And oh, by the way, San Diego is a big military area, receiving the second most amount of federal DoD dollars. The Department of Defense makes up almost 50% of the American federal budget, and the second largest recipient of all those federal DoD dollars is coming right here into our own backyard, into San Diego. When you dive into San Diego as a city, we see that San Diego, again, is number one on the list. I hope you're starting to see a lot of number one here, guys. We, California, have the more GDP than any other state. And within California, San Diego has the most growth in so many ways, from venture capital money coming in to downtown business growth. What you see before you is the top major cities, not just in San Diego, but all throughout North America, including Canada, in which cities, since the pandemic, have seen the most amount of growth in their urban core downtown. And San Diego takes the cake at first place. In fact, from just 2021 to 22, we saw 297 new businesses just in downtown San Diego. And since 2019, pre-pandemic, we have seen tax revenue downtown go up 19%. Again, it's all due to the growth that we have going on down in the downtown area. Next, folks moving here. Are folks moving into San Diego or are folks moving out of San Diego? The truth is, San Diego is growing. We're growing faster than just about any other city in the nation. It's become the #3 destination for people around the country looking to move to a different city. You see it here on the chart, the top 5 destinations: Miami, Sacramento, San Diego, LA, and Tampa. And again, with San Diego falling in #3. And most people moving to San Diego are, as you see here, are coming from LA, and out of state, they're coming from Seattle. Both major tech hubs. And we have a lot of folks coming here as well from the San Francisco Bay Area. Why are people moving here? Because you can't beat San Diego on so many levels. And now people can work remote. In fact, as of 2022, nearly a quarter of jobs were now remote. And if you can work anywhere in the world, San Diego is a place where talent wants to go. And we see this from a LinkedIn data survey that was done just last year. LinkedIn knows better than anyone what your job is, what your education is, and where you live, because these are the things LinkedIn tracked. And based on a LinkedIn survey that was done just last year, there's no city in the United States that has more tech talent growth than San Diego. As you see here in the bottom, San Diego's tech talent growth has grown by over 38% just from 2019 to 2022. Again, it's all painting that picture, if you will, that San Diego is growing more than any other city when it comes to tech. Now we can look at just the raw numbers. Population, where are people moving to? Again, don't believe the hype, don't believe the headlines, and don't believe random grifters or friends and family that don't study this data. Look at the real data. We just had a census come out. In fact, from 2010 to 2020, you can see on the depiction, United States in front of you, where did people move to over the last decade? The areas in orange are where people moved away from. The areas in green are where people moved to. And as you can see, throughout most of Central and Southern California, population growth actually was enhanced. It's the Northern California areas where we lost people. As you zoom in on this chart, you see by the numbers, where did people move to? Well, the darker the green, the more people move there. And you can see that it doesn't get any darker green than San Diego County. We had over 250,000 people moving into San Diego County in our region in just the last 10 years. You can see people also move to Texas and Florida, kind of these southern states gaining a lot of people. And a lot of times you hear people say that Californians are moving, they're moving to Texas because it's cheaper. It is true that California sends more transplants to Texas than to any other state, but a lot of people also leave Texas. And guess what the #1 state is that Texans move to? It's California. More Texans move to California than any other state in the union. Likewise, more Californians move to Texas than any other state in the union. California homes, though, cost a lot more. So what's happening? Highly educated, highly compensated people from Texas are moving to California. And the folks in California that are moving to Texas are primarily, not 100%, but primarily those that can't afford Texas. It's really a human exchange we have going on. And it's those Texans and people from the Northeast and people from the Midwest and people from the Northwest moving to California that are highly educated, highly compensated. They work in tech and they're raising our real estate values. Here you can see just how many people we have grown by. As I mentioned, San Diego County and Riverside County both grew by about 250,000 people in just the last 10 years as we look at the latest census. So is San Diego cheap? Guys, I'm here to tell you that San Diego is some of the cheapest real estate, not just in SoCal, but probably the world. And again, you might be thinking, well, Patrick, it's $1 million. $1 million isn't cheap. Well, let me ask you this. Is $1 million cheap compared to 2 million? Yes. Is $1 million cheap compared to 5 million? Yes. And if you want to really see the truth in economics, finance, real estate, just about anything, You don't need to have the ability to look backwards in time. Everybody can do that. You don't need to have the ability to look at today. Everybody can do that. You need to have the ability to look into the future. And as you saw on an earlier Excel spreadsheet that we showed you, if San Diego just keeps appreciating at the average rate of appreciation we've experienced in the last 35 years, and that's 6%, if we just appreciate at 6%, the median home of $1 million today in 30 years will be worth about 5.7 million. And that rate of appreciation of 6%, we're probably going to surpass that because of all the tech growth we have happening here in San Diego. So is $1 million cheap? It's cheap compared to $2, $3, $4, $5 million, and you're not going to see appreciation in most other markets the way you're going to see it in San Diego over the next 10 years because of all the tech and economic growth we just shared with you. Now, as I said, that rooster's coming home to nest, and we see that in the chart in front of you. This chart shows the rate of appreciation on an index scale between the three largest cities in California: San Francisco, Los Angeles, and San Diego. We see San Francisco is the goldish line, and San Francisco has always been the city that appreciates the most, has the most expensive homes, etc. But we see, as of 2021, for the first time ever, San Diego in purple started pulling ahead. It is not coincidence that that also aligns with when all that tech money and venture capital money started coming into San Diego. Because remember, the value of real estate has a lot to do with the value of the economy and the growth of the economy. And San Diego's economy is growing faster than any other city in California. And California's economy is growing faster than just about any other city in the nation. And where's most of that growth coming for our state? Right here in San Diego. This is why, folks, I draw that analogy that San Diego today is San Francisco circa 1990. If you want to buy a house in San Diego, buy it now. Because if you wait, you'll never be able to afford one based on the direction prices will keep going. If you want to be a millionaire, buy a San Diego home. Just hold on to it for 10, 20 years, and you'll be right there where you want to be. Again, we look back at San Diego prices and where they were in the 90s, and we see just how much the silicon boom of the 90s and 2000s increased real estate values in San Francisco. But you can't go back in a time machine because they don't exist. You can't go back to 1990 to buy real estate, but you can draw these analogies and you can make decisions today that make you just as wealthy by buying real estate in cities like San Diego that are mirroring what happened to San Francisco in the 1990s. When it comes to that lack of supply, guys, we're not going to build enough. I'm here to tell you the bad news. We're just not going to build enough. Not in my lifetime, probably not in your lifetime, because it takes too long to build the deficit we have. As you see here, most years, we build 10, 11, 12 million homes every single decade, going back 50 years. The last decade we came out of, 2010 to 2019, we built about half of that amount, guys. We built only 6.5 million homes during that last decade. And again, it's intersecting with the biggest population of first-time home buyers we've ever had. When you zoom in on San Diego, it gets even worse. I mentioned in San Diego that we need around 20,000 homes plus or minus just to meet our growing population demand growth. Well, specifically, we need 21,460 homes to be built. And you can see here, since 2015, we've only averaged about 9,000 homes built per year. We're just building too little. And when you look back the last 20 years, guys, there's not a single year that we went over 20,000. This is why I can wholeheartedly say, with as straight a face as possible, that home prices in San Diego will keep skyrocketing. We have more tech growth than any other city in America. We have more venture capital growth than any other city in America. And we are building less than 50% the housing stock that we need. In fact, we have been building less than 50% the housing stock going all the way back to 2006, over a decade and a half. Guys, we have a bigger population growth of these millennials and Gen Zers with good jobs. They want to buy housing. We don't have the housing. This is why for the next 10 to 20 years, you will see San Diego real estate values appreciate more and appreciate faster than what we have seen in the last 20 years. That is why I believe we'll see more than 6% appreciation here in San Diego. As we draw all of these correlations, and everything correlates to each other, as we draw them all together, we look at this graph and we go back to 2017. What you're looking at in the gold line is the number of household formations in San Diego. In other words, how many people are moving to San Diego? What you see in the blue line is how many housing units are we adding? Well, if you remember on previous slides, it's around 2018, 2019, 2020 that we started adding a lot of biotech, a lot of venture capital money, a lot of people moving in here to work in those biotech jobs. And that was our population growth. The gold line, the increase in households, it's all those highly paid, highly educated folks. And at the same time, we started building even less houses. You can see the blue line starting to go down. That is a perfect storm for real estate values to go up. As the Wall Street Journal and Forbes even agree, the housing shortage is worse than ever. And it's going to take a decade. It's going to take longer than a decade for us to make up the deficit of housing that we've created. As I mentioned, millennials now are in their 30s, first-time home buyer in age. Right on the heels of millennials, Gen Zers. Gen Z is now getting into their 20s, and nearly 50% of Gen Z wants to buy a home within the next 5 years. In fact, more Gen Zers want to buy a home than millennials. If you look at the graph on the left, when asked, do you want to own a home? 63% of millennials say yes. Right behind them, 87% of Gen Zers say yes. So we don't have enough housing inventory for a generation in their 30s in which 63% want to buy a house. What's going to happen when Gen Zers hit their 30s, which will happen in the next 10 years, and 87% of them want to buy a house? We're just not going to be able to house them. And that's why I can confidently say, not only are we going to see home prices continue to skyrocket over the next 10 years as the millennial generation goes through their 30s, we are going to see home prices skyrocket over the next 20 years as Gen Zers, another huge demographic generation, starts to go through their 30s in about 10 to 20 years from now. This is also why Lawrence Yun says, he's a chief economist for National Association of Realtors, we are not in a housing bubble. Prices will keep going up because it's simply a lack of supply. Another reason it's not a bubble, guys, and prices will keep going up is because this real estate market is not built on a house of cards. This real estate market is built on a solid concrete foundation of some of the best lending standards we have ever had in American history. What you're looking at right now is a mortgage credit availability index. The way you can interpret this chart is the lower the green graph, the harder it is to get a mortgage, which means the more qualified you need to be, which means the more solid the mortgages are out there on the market. And you can see that anyone could get a mortgage in 2004, 5, and 6. We had a high availability index. People that shouldn't have got mortgages got them. That's why we did have a housing crash in 07, 08, because too many people that shouldn't have houses qualified for mortgages. But in the last 15 years, it has been extremely challenging and hard to get a mortgage. When I say hard, I don't mean it's like going through a gauntlet, but I mean you got to have a job. You got to be well qualified. And that is why we are not going to see a crash, because we're built on a solid foundation of mortgages. So what are the experts saying? Well, this article came out in December and they were right. Anyone waiting for home prices to drop, bad strategy, not going to happen. And we saw coming out of December, January, home prices kept going up. In fact, Barbara Corcoran, who many of you know from Shark Tank, but she got her start in real estate. She's a self-made millionaire through real estate. And as she said just last month, it's a good time to buy real estate because when interest rates go down, everybody's going to go in and want to buy, and you're going to see prices go up. So what Barbara is saying is before prices explode and you're paid more for the same house, what you ought to do is buy your house now. Well, prices are still relatively low compared to what they're going to become. Buy your house now, 7% interest rate. And when interest rates go down, you will see prices go up, but you'll be happy because you already bought your house and you can refi to that lower interest rate. You get the best of both worlds. You buy at today's prices, not tomorrow's, which will go up, and you can refi into tomorrow's lower interest rates. Another reason to buy, I think I've already beaten this horse many times, especially with that Excel spreadsheet, but owners of real estate over time just have a higher net worth than renters. You see on the chart in front of you that the average renter in America has a net worth of around $5,000 to $6,000, whereas the average owner of real estate, because they own real estate and that's an asset that grows in value, the average homeowner has a net worth of around $250,000. Not too shabby. Just as much as real estate values go up, we know that rents go up. And as we look back over the last half a century or so, from 1988 to today, we see just how dramatically rents have grown in the United States of America, and they're continuing to grow. In fact, as you see in the chart in front of you, San Diego makes it in the top 10 cities for fastest rental growth in the last year or two. In fact, in just the last year, San Diego rents have gone up 29%, in the last 3 years. Being any of the cities here is pointing to a picture of a lack of housing available. But what really takes a cake isn't just the rate of rents going up, but when you look at San Diego today, you might have seen this as a headline just a week or two ago. San Diego has now surpassed San Francisco as the more expensive city to rent. In fact, San Diego is now the third most expensive city to rent in the entire United States of America. We're right behind New York City, in fact. And that trend is going to continue as we become more and more of a biotech hub. This is why I tell all of my clients, if you ever hope to buy real estate in San Diego, buy it now. Because if you wait 6 months, if you wait 12 months, God forbid, if you wait 2 or 3 years, you will get priced out of the market. Real estate values will keep going up. Whatever you can afford today, you will be able to afford less as time goes on because real estate values in San Diego will keep going up. So buy now. There's free money available to you. We learned through a survey that was done by Rocket Homes, what is the number one thing holding you back from buying your first home? And the number one obstacle, almost 22% of people said, is not having enough for a down payment. Well, what if you could remove that obstacle? What if I told you that the state of California and the city of San Diego have millions and millions of dollars set aside for first-time home buyers? The truth is, they do. There are dozens of first-time homebuyer programs out there that can give you free money to use towards your down payment so you don't have to pay the down payment. We just helped a client a couple of months ago now, actually, get $150,000 to buy their first home. And that $150,000 was given to them by the state of California. And you technically don't even have to be a first-time home buyer. You just can't have lived in a home that you owned for the last 3 years. You also don't need to be low income. You can make over 6 figures and still qualify for some of the first-time home buyer programs. So if you're interested in learning more about these and getting your down payment covered, shoot me an email and we can talk more about them. I'll close it out with this postage stamp that I love. It's a depiction of the California gold rush of 1849. And I like to share that there's a gold rush happening today, but it's not in the mountains of California, and it's not the gold you find in the dirt. It's the gold you find on top of the dirt in the cities of San Diego and cities like San Diego. There are people becoming wealthy, people becoming millionaires doing no work. All they did was buy real estate. If you buy real estate in San Diego and you hold on to it 10, 20, 30 years, as you saw with our average rates of appreciation, you will become a millionaire. You will become a multimillionaire by just holding on to that real estate. And you and anyone can take part in this gold rush happening right now by just buying and owning real estate in areas like San Diego. But also remember this, in order to cross the finish line, you must first cross the starting line. I can't tell you how many times I meet people that say they want to buy real estate, but they always talk themselves out of it. They always listen to the wrong person. They usually listen to someone who knows nothing about economics and real estate, and they convince themselves not to buy. They think there's a better time or a better way. I'm here to tell you guys, the best time to buy real estate is yesterday. The second best time is today. And if your goal is to cross that finish line and own real estate yourself one day, you need to first cross the starting line. So what does the starting line look like? Well, it typically looks like a meeting with my team and I. If you're interested in buying real estate now or in the future, shoot me an email, reach out to me and contact me. You, me, and my team, we can link up. We typically start out with a 1-hour introductory Zoom meeting. And during that 1-hour meeting, you can dial in from anywhere. It's usually a conference video call. We learn more about you. We learn more about your goals with real estate, and we start to strategize a plan. Maybe we can help you get free money for a down payment assistance. Maybe we can get you tens of thousands of dollars to help you buy your first condo, your first house. Or maybe you're an investor and you want to learn how to buy a duplex or how to house hack a property. Or maybe you don't know what you want and you just want to meet to further discuss real estate, what way the market's going, and what could be a good strategy for you. If any of those things are the case, shoot me an email. You can see my email address here in the top right of your screen. We can schedule a meeting with you, me, and my team and discuss what is best for you in real estate and the future. With that, I'm going to turn it over to Q&A. I'm going to look at the questions that came in. If you have any other questions, type them into the chat. I'll keep things rolling here for another 5 minutes or so while I go through the Q&A, and there's still time for you to put questions in if you'd like. I see the first question I'm looking at here is, when do we expect for supply to meet demand? When will prices decrease once that happens? I'll answer the first question. When do we expect supply to meet demand? Well, Jose and everyone else, I'm 42 years old. I plan on living to be at least 92, so another 50 years. And trust me when I say this, I do not think in my lifetime supply will meet demand in San Diego. Now, for the rest of the nation, I don't think it will there either, but in some pockets it will, especially in the Midwest where you can just build forever. But because we live in San Diego, we're really landlocked on where we can build. Pacific Ocean is to the west, Camp Pendleton is to the north, Cleveland National Forest is to the east. You can't build on National Forest. We have another country, Mexico, to the south. There's just not anywhere to build out to. So we're starting to do more urban infill, build density and build up. But our population is growing so quickly in San Diego, and we just cannot build enough. Even if politics allowed us to build much easier and cheaper, we still couldn't build enough because there's not enough land. So to your first question, when do we expect supply to meet demand? We don't. In San Diego, supply will likely never meet demand. Thus, over the next 10, 20, 50 years, you will likely see San Diego's rate of appreciation continue to outpace inflation. The long run term of inflation in the United States is usually around 2 to 3%, yet the long run appreciation of real estate in San Diego is 6%. So San Diego real estate typically outpaces American inflation by 2x. And we will likely continue to see that for the next 50 years We've certainly seen that for the last 50 years. So we don't expect supply to meet demand. We expect a lot of appreciation. You did ask, will prices decrease once that happens? But first of all, prices won't decrease over the long run. Of course, over the course of a week or two, a month or two, you can have fluctuations. We saw that over the course of about, I don't know, about 10 or 11 months, prices came down and then right back up. And that was only because of a short-term thing, interest rates. But a long-term trend, lack of supply, is always going to overshadow a short-term trend, like interest rates going up and down. But Jose, will prices decrease if supply did meet demand? No, prices would certainly they would just level out. They would level out and they would start going up at the rate of inflation. Some areas in the United States, like where I'm from North Dakota originally, born and raised, but I've lived in San Diego 20 years. But where I'm from in North Dakota, you usually see real estate values go up like 2 to 3% a year, the rate of inflation, because demand can meet supply because there's tons of vacant land and farmers' fields to go build on. But when you live in an area like San Diego, demand is always going to be higher than supply. We're just not going to see prices go down or that balance to happen. And even if it did balance, prices would still go up just at the rate of inflation. Jose also asked, when do you think we'll see 5% interest rates? I think we'll see interest rates get back in the sixes by the end of this year, 2023. I think throughout 2024, you'll see them trend down in the sixes. And I think we'll end 2024, so about 12 to 18 months from now, in the low sixes or the high fives. So to answer your question, when do I think we'll be in the fives again? I would say within 12 to 18 months, we'll be in the fives. And when will we be at 5%? That I think we'll be at 5.5% in about 18 months. I think for us to get to 5%, that's probably going to take about 24 months or so. But in the next 12 to 24 months, you'll see us in the low sixes, the high fives. And that's when the market is going to go bananas. Guys, if you think the market is crazy now, wait until rates get back in the low sixes or high fives. When rates get in the low sixes, high fives, thousands of buyers are going to flood the streets and start buying real estate and bid up the prices of everything. And this is why I'm telling my clients, if you want to buy now. With rates at 7%, you have less competition. But if you wait to buy for rates to go down, you're going to have thousands of competitors out there, buyers, also buying real estate and driving up real estate prices even further. So Jose is saying, when would you recommend to refinance if you get a 7% rate? Is there a rule that typically follows? No, refinance. Typically, if rates go down 1/4 to 0.5%, refinance. I own a lot of real estate throughout San Diego, and I've got a property that when rates were trending down from like 2000 to 2021 to 2022, we kept seeing rates go down. And I was refinancing that property like every 6 months. And I've probably refinanced that property a total of 5 or 6 times in the last 10 years. So almost every other year. And a good rule is if you can get a lower interest rate, refi the heck out of that thing. Because that's going to save you money over the long term. Now, because I have a master's degree with a focus in finance, I look at finance and money a little bit differently than your average American. I'm going to tell you firsthand, and this isn't to offend folks, but your typical human being, your typical American, doesn't understand finance that well and doesn't understand money that well. And you are often told that you should pay off debt as fast as you can. That's true with things like credit cards and car loans and student loans. In fact, I don't like that kind of debt. I've never had a car loan or a credit card debt more than a month in my lifetime because that's bad debt. But debt like real estate, my goal with real estate is to never pay off that debt. My goal is to get the lowest interest rate I can and take as long as possible to pay off that debt, because I know if you know how to invest wisely, you can make an 8, 9, 10, 11, 12% return on most investments, especially real estate, and you're borrowing the money at 4, 5, 6, or 7%. If you can borrow the money at 7% and you can reinvest it and earn 8%, you're earning a 1% positive. Why would you ever pay off that loan? But I would always refinance to a lower interest rate. an infinite amount of times, as long as my rates keep on getting lower. Let's see, Carlos is asking, what about investors preferring positive cash flow on an investment? Are there pockets or a creative method where cap rate can be balanced out with current interest rates? For that, I would recommend that deserves a 60-minute answer. So for that, I recommend you go to my YouTube channel. Just go to YouTube and type in Kappel Realty. When you get on the YouTube channel, search for the recording that is titled How to Cash Flow $100,000 per year. Carlos, I'm sure you'd love to cash flow $100,000 a year. So watch that 60-minute webinar that tells you how you can cash flow $100,000 a year. And you can do that buying San Diego real estate. I always say in the United States of America, including San Diego, every single property in the United States, negative cash flows. And every single property in the United States is positive cash flow. How can I say that? How can I say a contradicting statement that every property cash flows and every property doesn't? It's because your cash flow is heavily weighted based on the down payment that you do. If you buy property in a low cap rate area, like Coronado, let's say you buy a beach home in Coronado, right on the water. Coronado cap rate is like 2%. If you buy that property though, all cash, it's going to cash flow. Now I know you're not going to buy it all cash. But likewise, if you buy a property in the Midwest and you put 0% down, it's probably not going to cash flow. But I was explaining to someone earlier today, no matter where you invest in America, your cap rate plus your rate of appreciation are going to equal 9% plus or minus 1 or 2%. That's just math. The only people that should invest for cap rate, cash flow, are people who are retiring, they're done building their wealth, and they need dividends to come in the mail to them to pay for their lifestyle, i.e. they're retiring, they're done working. But anyone who's in their 20s, 30s, or 40s, and your goal is to build wealth, if your goal is to build wealth, you should build it through the most efficient means that doesn't get taxed, and that's appreciation. But there's still ways to cash flow hundreds of thousands of dollars when you invest in appreciating markets. In my YouTube video, just go to YouTube again, type in Kappel Realty. That will explain how do you cash flow $100,000 a year when you invest in low cap rate markets, as I do. And with that, it looks like that's it for the questions. So I'll close it out. I appreciate you all joining this evening. Again, I am going to upload tonight's webinar onto our YouTube channel. So if you'd like to share tonight's information with any of your friends, please tell them to go to YouTube, type in Kappel Realty Group, and they'll find this video and dozens others that will help them understand real estate, investing, and buying your first home in a much deeper way.